Well, I think ETCD, the exchanges are a very good alternative to the OTC market because a lot of the smaller and medium enterprises do not even get as much foreign exchange lines with the banking system. So even if they want to hedge, the ability to hedge with the banking system does not exist because they don't get the requisite credit lines in place. So first and foremost, exchanges are a wonderful place to be for those smaller corporates that do not get lines of credit or counterparty sort of lines to be able to hedge foreign exchange contracts. The second is that the liquidity in more than liquidity, I think I would say transparency that exchanges bring to fore is of a very different magnitude as compared to the banking system in general, and specifically the hedging banks very often do charge a reasonable margin on the contracts, whereas on the exchanges, you can very easily determine a certain margin that you'll offer to your broker, and you can see the bid offer contract rates on the screens or in any other form. So in other words, the transparency and liquidity and the cost of hedging is definitely better in exchanges, and therefore corporates, particularly the smaller and medium corporates, should use ETCD contracts very actively in order to hedge their portfolios.
What more do you think actually can be done in this market, actually furthermore to deepen this currency derivatives market so that you get a wider participation going forward as well?
Well, I think that's a very good question, and I'll tell you that for the last many years, what one had been hearing, even as a banker for long, was that there was a plan to, at some stage, to deepen the exchange-traded currency derivatives market. To deepen that, it was very essential to be able to allow the hedging corporates to deliver the foreign exchange contract that they enter into the first place. But at this moment of time, even after many years of deliberation, I suspect the contracts are still cash settled. What I mean by that is that an SME or a medium-sized corporate, like I keep mentioning, they yet have to go to the bank when they realize the payment for exports, or if they have to make a payment for imports or capital flow. They have to go to the bank as separate or distinctly, different contracts have to be taken in place at the point of sending the money out or bringing the money in, other than the hedge contract that may be standing in the exchanges, which has to be necessarily cash settled. In other words, there are multiple margins the counterparty, corporate counterparty has to pay in two places, and that reduces the efficiency of hedging. And therefore, one of the crying needs in the Indian market is to be able to bring in a physically settled contract in place for foreign exchange contracts and not necessarily restrict them to cash settled contracts.
And lastly, Mr. Mahajan, I want to understand, what is actually there in these other world exchanges in terms of the forex, which our exchanges and regulators can actually bring in and should look at.
Yeah, so there are many things. Frankly, there are multiple lessons to derive from more liquid and large exchanges around the world. So I think the lessons, when I sort of just compare to the Indian market, I would say that we need more currency pairs. At this moment of time, we only have dollar rupee and three other currencies, which is euro, the sterling pound, and the Japanese yen. As you would recall, Indian trade with counterparties like Russia, like Canada, like Australia, and many other countries, even in Europe, like the Switzerland, and so many more, is going up rapidly. And I think there should be hedges available on exchanges in regard to ruble to rupee contract, likewise Canadian dollar to rupee contract, Aussie dollar to rupee contract, and so on and so forth. So I think just the multiple alternatives to be able to hedge across a basket of currencies is quite restrictive in India, number one. Number two, I think the forward market is simply not active or not liquid. The only first month currency futures is quite liquid. But if you want to just take a premium position, as in you want to pay 1 year forward premium starting the first month, those type of contracts don't have the liquidity to be able to help the exporter or importer. As you know, with dollar interest rates and US and rupee interest rates, there has been reasonable volatility in the last 12 months. And a premium, just the premium, not the spot contract, but the premium goes up and down quite rapidly. And sometimes exporters want to lock in that premium or importers want to lock in that premium. But that optionality today on the exchanges does not exist. Likewise, there are some other points as well. But I think if I were to prioritize, I would say multiplicity of currency contracts is quite restrictive, and therefore we need to widen the scope and also let more contracts become more liquid